Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education at Schwab. This is Getting Started with Options. Long options have the ability to take a small move on a stock and turn it into a big profit or even a big loss. So that's what we call leverage. Today is going to be a beginner's guide to understanding how leverage on options really works. So we're going to be getting into the weeds here a little bit, really understanding the mechanisms behind this thing called leverage. It should be a great discussion. Before we can get into any of that, though, let me first of all say hello to everybody out there in YouTube and our live audience. Great to see so many familiar names out there. Hello there, Bill and Mighty Mouse, Will, Susie Q, Naresh, Eva, Sharon, Jose, JB52, and everybody else. Thanks for joining us week after week. As I always say, we really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I do want to welcome you. And if you are watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live discussion. This is a Tuesday webcast series, kicks off promptly at noon Eastern time. If you'd like to join us in the live stream, that would be fabulous to have you here as an audience member. If you're watching, I also do want to say to whether you're watching on the archive or you're here in the live discussion, in the live stream, we have guests that sit in the chats, help me with questions that I can't address today. We have Connie Hill, who's going to be hanging out in the chats, helping me with any questions, but also Kathy Nguyen. Great to have you here, Kathy. Both of those women bring some great knowledge and experience to this discussion. Thanks for having my back there. And Connie and I would like to issue an invitation to everybody watching. If you're not following us on X, and if you have an account with that platform, give us a follow. It's the very, very best place to connect with your favorite presenters in between the live streams. You can find Connie on X at Connie Hill CS. My handle on X is at Cameron May CS. So love to see you there. But let's get into this discussion of the leverage of options. What is the mechanism? What might it imply for the potential for success or failure on the trade? And the really rapid pace at which that can be realized. But before we go to that discussion, of course, we need to pause to consider the risks associated with trading. This certainly applies to options, so bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as sole means of investment research, and investing involves risks, including the loss of principal. Okay, so let's set the agenda for what we're going to be talking about today. We have about 45 minutes to spend together today. Let's spend it wisely. I want to talk about this thing called leverage. So we're going to be using an example long call option. It's, just to be perfectly clear, it's maybe not the best current environment for call buyers, or at least it hasn't been over the last 3 or 4 weeks. But I think that for learning purposes, most people tend to relate to call options more readily than the put options, and the knowledge that we gain here for calls tends to translate very smoothly over to puts. So we're going to be learning through the lens of a call option buyer, talking about the leverage that might be accomplished through the purchase of a call option. So I'm going to use an example stock chart to set up an outlook for a stock. And then we're going to discuss how an option delivers leverage for that outlook. We're going to use a real example. We're going to be breaking down different call options and be using some of the tools on the Thinkorswim platform to illustrate how leverage really works. So let's get right into this discussion. And by the way, someone just chatted in, says you're following somebody on X. You think it's one of the presenters, but you're not sure. Here is the standard template. If you're following us on X, make sure first name, last name, CS for Charles Schwab. That's the template. So mine, for example, is Cameron May CS, at Cameron May CS. Connie's is at Connie Hill CS. One of the issues with social media that is probably just going to be there forever is that there are fakers out there. There are would-be scammers. So you just have to be sure that you know who you are actually dealing with. So let me show you. If you're on X and you're looking for me, This is me at Cameron May CS. If there's an extra dash, if there's one fewer letter, the fakers will grab the picture here, or they'll grab my image, create a fake account, block me from seeing it, and then try to convince you that it's me. So that's your coach right there. All right, but great question there. But back to our discussion of leverage on a stock. Here is CVS Health Corporation, and unlike so many companies out there that are selling off, and they've been selling off hard. We've seen actually a correction on the major market indices, more than a 10% retracement from recent highs. But unlike so many stocks out there that are going down, CVS has actually been having a nice run up. And during that retracement, that correction on the major indices, CVS has actually managed to tread water, which is a bit of an accomplishment. And if we look at what's happening just today, we might be pushing up to new highs. If we can close where we are, CVS could wind up at highs that it hasn't seen since April of last year. So for some, they may see that as a sign that maybe there are great things to come for CVS in the near term. Obviously, we don't know. Nobody knows for sure. But a couple of technical points that a trader might make on a stock chart like this. Number one is that break of that previous price ceiling. Right around 67, that has held as a price ceiling for about 8 or 9 months now. And as of this moment, it looks like we're breaking up from that. Let's take a closer look at what's happened over the last 4 or 5 weeks. Those of you who have a little bit more of a technical orientation, what do we call this when the highs are roughly equivalent on a stock chart, but the lows are pushing higher? So the buyers seem to be pushing upward while the sellers really are only able to maintain kind of a steady front. What do we call that? Equal highs, rising lows. Some might refer to this as an ascending triangle, which is seen by technicians as a potential continuation pattern of whatever the trend was before that triangle set up. And in this case, that trend was upward. So yeah, Doug, an ascending triangle, exactly right. So on the breakout of that triangle, some might look at the depth of that pattern, which is about $5, and look to a potential new $5 move to the upside in this case. So if we're breaking out at 67, maybe they might think that we're going up here to 72. Something else technical traders might look for is how far we've moved on the major upswings in an uptrend. And interestingly, CVS, since they hit these lows back here a few months ago, raced up about $13 and then pulled back. It raced up about $13 and then went sideways into this triangle. If we're breaking out and we're maybe set to race up again, how far might we go? Well, for some, they might look to recent history as an indication of what the future may hold. And maybe they think that it could go, maybe it goes to that $5 target, could go beyond that. Could it possibly make it to $80 from where it is right now at 67, or a breakout level of 67? Maybe, we'll see. But with those sorts of technical observations, let's just say that our trader thinks this stock has some upside potential. Whether it ultimately goes up $5 or 13, maybe it doesn't go to either one. One thing they could do is buy the stock. So to buy a share of CVS Health Corporation is about $67.50 right now. In other words, 100 shares would be about $6,750. And then if we went up $5, let's do some quick math here. Let's do a comparison. This is going to be example trade A. Example trade A is to buy the stock. So let's say we buy 100 shares, and I'm going to do a little bit of rounding and say we get it for $67.50 on the nose. Now, obviously, it's a couple of pennies beyond that right now, so we're being a little bit generous by rounding that 2 cents down to $67.50, but I think it's just going to make the learning a little bit easier. So if we buy the shares at $67.50, and let's say the stock does go up, so let's say it started its move at $67. So we're 50 cents into that right now, but it continues up another $5 to $72. That would be a five or about a $4.50 return on our 67.5% or $67.50 investment. Let's do some math on that. A $4.50 return divided by our 67.5 investment is about a 6.7% return. So let's say we assume stock rises to $72. That's that level right there, okay? This would produce about a 6.7% return. All right, so for a stock trader, is that a good return? Yeah, you know, in an average year, the S&P 500, on average, over a long period of time, has been around 10%, roughly speaking, in return. So that's about 8 months worth of productivity, and if it happens relatively rapidly. If we just get up here, that's about 8 months worth of productivity in a comparatively short period of time. Well, let's say that our trader is quite confident in that outlook, and they want to leverage that outlook as much as possible, or at least to some extent. Well, in that case, they might consider doing another example trade. Let's take this information. We're going to copy that and paste it down here. And instead of buying the stock, we're going to buy a call. All right? Let's go to our trade tab. And how about, let's give this thing some time to work. Okay? Could the stock make it up to $72 in relatively short order if it has a mind to do that? Yeah, maybe in the next week or two, who knows, right? But what if we also ultimately want to leave the door open to get all the way up to $80? Well, the previous $13 moves, this one took about a month. This one was spurred by earnings and accelerated up in just about a week. So let's say we want to make sure that we have at least a month on these contracts. And what some traders will do is double that. And interestingly, if we do 2 months and we get a strong move to the upside within that time frame, there could be large potential reward for our call. But let's stretch it just a little bit further, because it was an earnings announcement that spurred this most recent strong acceleration upward. How about we go out 3 months, so we're actually going through the next earnings announcement. So we're going to carry the potential of that earnings announcement as well. So I'm going to go to the trade tab here, and let's go out here to maybe the 20th of June expiration. Those contracts have 94 days till expiration, and they are for the potential purchase of 100 shares of CVS. So I'm going to go in those options down the middle row, which shows us the prices at which we might strike a deal to potentially buy the shares. Let's do the 67.5 strike price. So instead of buying the stock at 67.50, we're going to buy the 20th of June 67.50 call. And it looks like that's going to cost us, you know, between $4.85 and $4.95. Let's call it $4.90. So there's a significant difference in the trades already. So here the trader is buying the shares at 67.50. Here the trader is paying for the right to buy the shares, but not today, but actually any day between now and the 20th of June, or any day over the next 94 days. Now that right comes at a much lower price point than actually laying out the money for the purchase of the stock right now. We are spending, as a matter of fact, let's do some additional math here. Let's get our calculator out. If we're spending $4.90 instead of $67.50, the cost here is 7.3% of the cost to purchase the price. Okay, 7.3% of share cost. Does that make sense? Spending a fraction. So I have to address a misconception that I had when I first started learning about options. I thought, okay, so we buy the stock, we buy the option, and then if the stock goes up $1, we make $1. Awesome. And if it goes down $1, we lose $1. Not true. We actually make a fraction or a portion of $1 if the stock goes up or down. Make a portion or we lose a portion. Make a fraction or lose a fraction. How much can the trader stand to make on a $1 move up on CVS? How can we discover that? Somebody out there knows the answer right away. You can chat it in right now. But if we pop up here, right now, the columns that I have displayed are the bid and the ask column. These are quote columns, and they're fixed, they're static, they're always there. But we also have the last X, which just means the last price, and the net change in price of that option. Yeah, William, what we need to see are the Greeks, or specifically the delta. The delta of an option provides direct insight into how much leverage each option carries. And each option carries a different degree of leverage. So this is really important to understand. Okay? And Kevin also brings in, thank you, Kevin. It's definitely in my notes to discuss this, gamma. Yeah. Oh, and by the way, let me change this up so that we can see our Greeks. So if I go up here right next to where it says spread single, the next area over, I'm going to change that to delta, gamma, theta, vega. That's going to show us our 4 primary Greeks here. We're going to be focusing on the first 2. But before I do that, let me first of all say, I just noticed in the chats, and it's been reposted already. It is survey time. It's not every webcast where we have the opportunity to give your presenter some feedback in the form of a short survey, but we can now. So everybody here that's in the live stream audience, go ahead and click on that survey link for me if you would, and fill that survey out when the webcast is over. You can give me some honest feedback. I just want to say the surveys are really valuable to your presenters. So please do make it a habit. If you see a survey, click on it, fill it out afterward. It literally only takes a few seconds. It's only 2 multiple choice questions. You could just be done right there. Or you can also take a little extra time and fill in a comments box or a suggestion box. But if you take the time to fill out a survey, I promise I'll always take the time to read through that survey data, read through the comments. That stuff comes directly to your coaches. It's also reviewed carefully by our management team, so it definitely helps. Okay? So back to our discussion of the Greeks. And I am going to be focusing on delta and gamma, which combined really give us some good insight into the leverage that's provided by an option. But I don't want to dismiss the importance of the other 2 Greeks. I actually did a recent webcast. I have a series of 10 lessons that we just concluded last week that are intended to bring along a new person who's just learning about options, teaches them all about options, and then how to combine the options into different strategies. But lesson 5, we went deeply into the weeds on Greeks. So I called it lesson 5 of 10, the vital role of options pricing and the Greeks. And I want to give you a link to that lesson if you want to go see a review of theta and vega. So let me post that. I just pasted that in the chat. Let me throw my initials on that. And also, if you do want to, let me just point out for the benefit of those that are watching after the fact, if we go to our playlist here, we can scroll down, just scroll pretty much toward the bottom, and you're actually going to be looking for Barb's face because she used to teach this webcast series. But right here is the full playlist. So if I click on that playlist, there you go, lesson 10 of 10, lesson 9 of 10, 8 of 10. That's what I just provided the link to. All right. So if you're not subscribed to our Trader Talks channel on YouTube, make sure that you do that. Go down, click on the subscribe link. That's where we house our playlist, and you can also join our live streams here. So Ranjit says, I'm sorry, but is this 10 of 10? Nope, that was last week. What I'm doing now, we've concluded my 10 lesson series. Now we're just going to sort of be putting everything into practice, but also building on what we learned from those 10 lessons. So let's go back here and let's, and John, you're saying, oh, let me see if I get a question. Is the last line on the scratch pad correct? Is it a 6.7% return? Yeah, on the stock, a $4.5 return on a $67.5 investment was the 6.7% there. Yep, that's what that is. In any case, this we need to change because we haven't updated it yet for the call. We want to see what kind of return is potentially available to the call buyer now. So let's put ourselves in the shoes of that call buyer. We just bought the call option for $4.90, which is a fraction of the cost of buying the stock. Now, let's assume the stock goes up $1. Dollar being a key word here. Dollar starts with D, so does delta. That's the way I think about delta. It's the potential for gain or loss on a $1 move on the stock. Now, importantly, delta always assumes the stock goes up. Does the stock always go up? Of course not. But the assumption that the outcome here that's displayed under the delta column is positive. It's assuming a positive move for our call buyer. So, going back to our question, if we buy this call for $4.90 right now, and if the stock pops up $1 immediately, so no time decay, let's say our volatility hasn't changed, really the only thing that has affected the value of the option is movement in stock price, how much of a return have we accomplished? 54 cents. Now, you might say, well, it's approximately 54 cents. No, it is 54 cents. There is a prescribed formula for the calculation of the value of options called the Black-Scholes model. It is the way that options are priced. So if the stock makes a pop of $1, while time decay and volatility moves haven't had a chance to have an impact, and the only thing driving performance of the option is that movement on the stock price, this is the outcome, 54 cents. Gained if the stock goes up, lost if the stock goes down in the form of unrealized gains or losses. We haven't closed out the contract yet. So how much is that? Assume the stock rises to $72. Well, let's peel that back to just $1. Let's assume the stock goes up a single dollar. And as a matter of fact, let's do that up here. Let's assume the stock rises just $1. Well, a $1 move, if we had purchased the stock, $1 divided by our $67.50 investment would be about a 1.5% return, right? Well, what if we get the same move upward? Assume the stock rises $1. We get a 54-cent unrealized gain, unrealized profit on our $4.90 investment. Wow. 54 cents divided by $4.90 produces an 11% return. That is massively larger. That is nearly 10 times. What is that? It's actually more like 9 times. Let's do some. Why not? 11 divided by 1.5. It's actually 7 times. Okay, my math could be better on that point. But anyways, 7 times the rate of return. The same $1 move produced a 1.5% return on the stock ownership. It produced an 11% return on the option. Now, that is leverage. Now, leverage can work in either direction. What if the stock fell $1? Can we say ouch? Well, the stock fell $1. We paid $67.50 for it. Now it's worth $66.50. Okay, we're down 1.5% on the stock, but on our option, that delta works in equal proportion in the opposite direction. If the stock drops, we lose 11%. That is a big gain or a big loss. That is some serious leverage on that option. But for our trader who thinks, well, I think this stock is likely to make a nice run up, it's really dialing up the potential for reward here. And that's what can be so attractive for an option trader here. But we also just have to keep our eyes wide open to the risk of the trade. So now let's start to address this. Let's assume the stock doesn't just go up $1, but it goes up multiple dollars. Well, another thing that we have to be aware of in measuring the degree of leverage that we're getting here is that that leverage changes. And as a matter of fact, as a stock moves in the anticipated direction, that leverage actually gets greater. There's more leverage on the trade compared to what we originally spent for the option. And there's a way to measure that. And who was it? I got to give credit where credit was due. Somebody pointed out with the Greeks. Kevin says delta and gamma influence that leverage. They give us insight into leverage. Harris says, because it's 90 days till expiration, should we use a stop loss or no? Leverage can have important implications for using stops. So yeah, we want to talk about that. That's a great question. All right. But here's one of the shortcomings of our Greeks. And since we're talking about delta, we'll talk about it through that lens of delta. It only tells us how the first dollar does. After that, things change. So that's where we need gamma's help. See where it says GA ... That's our gamma column. And as I look down here, that gamma says 3. What is that telling us? Well, for some traders, they refer to that as the rate of change to delta. That sounds like a lot, but really what it's helping us do is calculate how much we could make or move on the second dollar move on the stock. So if our stock rises $1, we know that we could make 54 cents by using delta, and delta is accurate. Gamma tells us how to calculate that second dollar. So let's make a new assumption. Let's assume the stock rises $2. Well, in that case, the first dollar still produces theoretically the 54 cent gain in our call. The second dollar will actually produce a 57 cent gain. So what we do is we take gamma, we add it to the original delta, and that tells us the potential for gain of the second dollar. So it is literally the rate of change to delta. Delta changes by this gamma amount. So if the stock goes up $1, we make 54 cents. If the stock goes up a second dollar, we make 57 cents. Let's assume those things happen almost instantaneously, so time isn't playing a factor. Let's say that our volatility holds steady. Vega's not playing a role. How much leverage is that on the second dollar? Well, 57 cents on our original $4.90 investment is now 11.6% additional potential return. So after $2 up, we're actually looking at about 22.6% return. Yeah. So that's a lot, right? And actually, the more the stock goes in our direction, the more that leverage actually expands. So we have to be aware of that. It's not that this is a static number and we're getting 11% return on each dollar. In the new direction, that leverage starts to dial up. Interestingly, if the stock falls, the leverage dials down. That's because our option is losing money, and as it loses money, there's just not as much left to lose of that original investment. So let's do the math on this. What do you suppose if 54 cents is how much we could lose on a $1 drop in price? How much might we lose on a $2 drop? Somebody do the math on that for me. I'll wait. No, on the first dollar, we might lose 54 cents. On the second dollar, it would be 54 cents minus 3 cents. So it'd actually be 51 cents lost on that second dollar. So we're losing less, but that's because there's less left to lose. Does that make sense? If we bought the option for $4.90, stock falls $1, now that thing's only worth $4.36. Then we lose 51 cents on the second dollar, and so on until it bleeds down to 0. Let's see. RG says, does that mean the third dollar would increase the option price by 60 cents? RG, pretty much. You're on the right path there. The problem is Delta shows us the first dollar. Delta plus gamma show us the second dollar. But after that, these Greeks are in constant flux. Our gamma is changing, our delta is changing. We actually need the support of a calculator to help us out with expected reward and risk scenarios beyond about $2. And that is where a different tool is actually going to be really helpful here. Let me hide my left column here for just a moment. And I'm going to change my, actually, we can leave the left column open. It's just fine. Anyway, but I'm going to come up here where I'm displaying my Greeks, and I'm going to use a tool known as the Theo Price Calculator. John says, what is this thing you're calling? Is this math? Yeah, this is the math of trading options if we really want to understand leverage, and it's important to understand this leverage, but we still haven't gotten enough math to be able to figure this out. We're assuming the stock might go to $72. Maybe it goes to 80. How much might the trader make if it does either one of those? That's where our Theo Price Calculator comes into play. The Theo Price Calculator already knows all this stuff about delta, about gamma. It's built right into the calculator. So we can come up to this and just put in our trade assumptions. First of all, let's do something that's highly improbable. Let's say this goes to $72 today, so no real time impact. So really, the only variable here, let's first of all hit reset from the last time that I used this calculator. So let's assume that volatility doesn't change. Let's assume that no time has gone by, so it's still March 18th, but that our stock price goes up another $4.50. Why did I say $4.50? Because from 67.5 up $4.50 takes us up to $72. Okay, so going back here to our Theo Price, let's put in 450 plus. You can put in the plus sign if you want. You will need to put in the minus sign if we're assuming that the stock goes down, and we do want to see that. But once we've entered this in this calculator, we can look over at this column that says Theo Price. This is sort of like the display on your calculator. It shows you the outcome. And so we look at our strike price of 67.5, and you see right here it says 771. That's the value, that's the projected value of our option using delta and gamma, even with changes, if the stock were to go up $4.50. 771. So if we were the stock owner, we would have made 6.7% return. If we own this call, let's do some math here. If our call is now worth 771 and we paid $4.90 for that thing, that's a 281 return, or in other words, on a 490 investment, that is a 57% return. 57% on just a $4.50 move up on the stock. So from here to there, this call owner stands to possibly make 57% return. Now that's if it popped up directly. So Kevin says, what about that volatility adjustment? Well, Kevin, if stocks get choppier, if they get more volatile, that tends to raise the price of options. If they get quieter, it tends to lower the price of options, because options buyers tend to want to buy the more volatile, to buy options on stocks that are more volatile because they can move faster and make more money. If they're really quiet stocks, they don't tend to move very much. Options buyers just aren't as excited about those. That's the concept there. But yeah, changes in expected volatility for the time frame of a contract can change the price of those options. And what we're doing with this calculation is just not making any assumptions about that. Okay, maybe volatility expectations go up, maybe they don't go down, maybe they go down. We're just going to assume for this that it's just price moving on the stock. Okay, but also time does pass. So if we make our $4.50 move, but let's say it takes a week to do that, what's that going to do to the expected value of the option at the end? Well, time negatively impacts the value of options. The passage of time does. So let's click on our little calendar here, and we can build in that time element. Let's say it takes a week out to March 25th. And if we look over here now, we were looking at 770 or 771. Now it's only worth 748 because of that decaying impact of time. Okay. If you don't know why time has an impact like that, make sure you watch that video that I linked there, or make sure that you go find it on the channel where we talked about the other Greeks, theta and vega. I just wanted to focus on volatility today. Okay. So this calculator, though, can be really valuable. Now, let's get a little bit more aggressive with it, and let's assume the stock makes a big run. Assume stock rises to 80 bucks. That's up here. All the way up there, okay? That would be, what, a $12.50 return on stock ownership. $12.50 return on a $67.50 investment is 18.5%. I'm not going to type in the word return. You know what we're talking about here now. Well, what might that be? Oh, by the way, what did we say here? That was going to be 22.6% return on a $2 move. On a move to $72, that would be our 54% return. Well, let's come back here now, and let's make a couple of assumptions. Let's be realistic. The stock is probably not, it's almost certainly not going to $80 today. It's just highly unlikely. Let's say it takes a month to do that, if it does. So that would be out here. Let's just go right out to the 18th of April is a holiday. Let's go to the 17th of April. Okay. And let's say the stock goes up $12.50. How much is the value of that option? $67.50 call that we bought for $4.90. By the way, it's gone up a tick since we first started talking, but now it's worth $13.36, $13.37. $13.36 value on an original investment of $4.90 is an 8.46% or an 8.46 return. Divide that by $4.90, and this 18.5% move in the stock has produced a 172% return on our call, and that includes the passage of a month of time. So how is that for leverage? That's a massive amount of leverage. Obviously, if the stock goes the opposite direction, we can lose money. How much can we lose on this trade? If we spent $4.90 on this call option, how much can we lose? The theoretical maximum loss on this is the investment, $4.90. So our trader might be looking at this and saying, wow, I could about triple the value of this thing, or I could lose all of it. Maybe I ought to have a stop plan in place. So somebody asked me here, and why don't we just, let's round this off with this. Assume the stock rises to $80. That was about a 172% return. But as attractive as that can appear, it's also a low probability outcome, and we also have the risk of even losing the full amount of our investment. So let's talk about managing that downside now. And this leverage can have implications. When we are buying options, if we use tight stops, well, we've already seen how just a $1 move can move the value of our option by 11% in this case. And as a matter of fact, if we chose a different option, it will have even more leverage potentially, depending on the option we choose. If we go in the money, the leverage goes down because we're spending more, we're getting closer to the cost of buying the stock. The more money we have to spend to buy the option, the less leverage that delivers. Let's switch back to our Greeks here for just a moment. And how about we look at maybe going deep in the money? Maybe we buy, instead of buying the 67.5 call, We buy the $55 call. That's a substantially more expensive call. It might cost us, let's say, $13.80. Then if the stock drops $1, we might lose 87 of that 13.80. Let me do a quick calculation here. An 87-cent loss on a 13.80 investment means that this in-the-money contract lost about 6%. That's about half as much as the one that we've been discussing. The less expensive the option, the more leveraged it is. The more expensive the option, the less leveraged it is. I think that just makes sense, but that's the math behind that. So what's the implication for managing the stops? Well, if we're spending more on the option, we can actually get away with a tighter percentage stop because it's just not as volatile. It's less likely to get stopped out on a relatively small move. If we're buying less expensive options, the trader will typically want to use a looser stop because those things are more volatile. And tight stops, you get whipped right out. So, for example, if I bought the 67.5 and I put a 10% stop on that, how precise do I have to be with my timing on the stock to avoid getting stopped out, or to hopefully avoid getting stopped out? Well, this thing on a $1 move, this one could get stopped out. The same $1 move would not push this one down 10%. This one would only go down 6%, so we might be able to get away with a 10% stop. So yeah. So as a general rule of thumb, what some traders will do is the more they spend on the option, the tighter the stop as a percentage. So as an example, buying an in-the-money contract, maybe a trader uses like a 30% stop. Buying an at-the-money contract, maybe a trader uses something like a 50% stop. Buying an out-of-the-money contract, those are highly leveraged. Maybe the trader just risks the entire thing. They're not spending a lot of money, and these contracts carry the same unlimited upside potential as other call options. So maybe they just say, well, I'm buying this, we'll see how it goes. I can make a ton of money if it goes up. I can lose a limited amount if it goes down, meaning I can lose the whole investment, but it's just not as expensive as others. So let's do our trade here. Let's do that 67.5 call. I'm going to buy it. Looks like it's going to cost us about $5 at this point. And let's put a stop on at 250. Okay, that's half. So let's right click and let's put in a custom buy order with a stop attached. So that creates an order to buy one contract. If we buy a contract at $5 and we put a stop in at 250, that might be conceptually about a 250 risk. Now, obviously, we don't know ultimately if we get stopped out, are we going to stop out at exactly 250? That's not guaranteed. It just means if the price happens to fall to 250, that kicks in an order, a market order to sell, and we could sell for that price or less. Possibly it could come down and touch 250 and then sell for more, but just be aware that if we get a strong gap down, we could actually lose more than 250. But here's where the trader might calculate, well, if I have conceivably here a $250 risk, let's say we didn't want to hopefully lose more than $1,000, maybe I'll do 4 contracts. There we go. But let's go ahead and confirm and send this order. I'm going to buy 4 of these, buying 4 of the 20th of June 67.5 calls for $5. We have a stop in at 250. That's a 50% loss. So that would be about what? About a $4 or $5 move on the stock could trigger this. And that stop, another important note here, is due to potentially wide markets or liquidity risks at the time of activation. This order, the stop order, may be manually substituted with a limit order upon activation and worked until it's filled. Now, there are commissions to be considered here. There aren't on every type of trade, but on options there are. And let's send that order off. And okay, we just bought for $4.85, actually a nickel less than we were planning. All right. So guys, we have just broken down in good detail the leverage inherent to call options. Now, these same concepts can translate very smoothly over to put options. So we'll talk about that in a future webcast. But this is what we do on our Tuesdays. We talk about getting started with options and understanding the important elements of options trading. We even had an opportunity here to talk about how that leverage can have implications not only for the upside of the trade, but also for the potential downside management of the trade. All right, everybody, time for me to let you go. But a few reminders. Number one, if you're not subscribed to our Trader Talks channel, please do that. Go down, click on the subscribe button right now. This is where you can find the playlist for our previous webcasts. You can join our live streams here. Also, make sure that you're following us on X. You can find Connie there at Connie Hill CS. You can find me on X at Cameron May CS. Be very precise. Make sure they are exactly those, because you want to make sure you're following the right person. And also thank you to everybody who's already given the thumbs up. I definitely appreciate that. Looks like 180 people watching. We've already had 55 likes. That's always appreciated. Guys, there is a survey, so here's my final reminder. Give me if you take the time to fill out that survey, it's always appreciated. Everybody, I will see you next Tuesday for another discussion of getting started with options. I'll also look for you in my other webcast series, something new every day of the week, so you can look for that on the calendar. But whenever I see you again, and I also want to say I will look for you on X as well, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.